Now let's practice how to record the capital lease for lessee, focusing on the lease term and fair value criteria. We have four criteria to be classified as a capital lease. First, is there a transfer of ownership, and is there a bargain purchase option, and the lease term is longer than 75% of economic life of asset. And then finally, present value of minimum lease payments is greater than 90% of fair value of the leased asset. That means that the lessee uses the capital lease asset most of the time and most of the value, and ownership transferred, and then bargain purchase option that has an option that purchases lower value than the fair value at the end of the lease term. So the transfer of ownership is almost guaranteed. So let's go. The lessor company and the lessee company sign a lease agreement dated January 1st that calls for lessor company to lease equipment to lessee company beginning January 1st. So okay, and then the term and provisions of the lease agreement and other pertinent data as follows. The lease term is 3 years with a non-cancelable agreement requiring equal rent payment of $23,933.54, including the property taxes of $2,000 at the beginning of each year. So this concept of the payment, lease payment, is annuity due that the payment recur every beginning of the year for 3 times. And then the equipment has a fair value at the inception of the lease of $60,000, and then estimated economic life 3 years and no residual value. So the lease term and the estimated economic life is the same. So we met the criteria of the capital lease. And then the fair value is $60,000. We haven't calculated the present value of minimum lease payment yet, but we'll compare soon. A lessee pays all executed costs directly to third parties except for the property taxes of $2,000 per year. This tax property is included in the $23,933, the rent payment, equal rent payment. So actual payment of this lease is $21,933, except for this $2,000. And then, what else? Okay, the lessee company's incremental borrowing rate is 11% per year. Lessor company set the annual rent payment to earn a rate of return on its investment of 10%. Okay, when we choose the discount rate, we choose the lower of the incremental borrowing rate of the lessee and the rate of return on investment for the lessor. So we are going to use 10% because based on the conservatism, the capital lease obligation is going to be the higher if the company uses, if the lessee uses the lower discount rate, low discount rate, so that the capital lease, the obligation gets higher. Then we have the time value of money function, period 5, 10%, the present value of annuity due, 2.73, blah, blah, blah. Okay, so we already know the capital lease. This is capital lease the case. The lease term is greater than the 75%, because the 3 years is the lease term, and the 3 years is the estimated economic life. So are the same. Then we will prove that the present value of a minimum lease payment is equal to 90%. We haven't calculated yet, but yeah, we'll see. Okay, as we discussed in the class, the CLA is equal to the CLO. The capital lease asset is equal to the capital lease of the obligation at inception. Then this value is calculated by the minimum of the fair value of a leased asset and present value of minimum lease payment. Discount rate, as I mentioned, we use the lower one. And then minimum lease payments, we calculate. How to calculate? Annual payment is including the property tax, we have to deduct, we have to subtract this, the property tax, and then times annuity factor. Annuity factor is calculated like this, as we practice in the principal finance or corporate finance class. Now, let's calculate annual lease payment less property tax. What is the actual annual lease payment amount? Okay, we have a given number to 3,933.54 minus $2,000 tax amount. So actual annual lease payment to calculate the minimum lease payment is $21,933. And then we have annuity due. Annuity due means the payment that recurs every beginning of the year. So we have this annuity due 2.7355372. Okay, we are going to use this, the annuity due factor, in order to calculate the present value of the minimum lease payment. We can just simply multiply this 2. So we got the $60,000, which is the same as the $60,000 fair value of the leased asset at the inception, which is given number in the question, the wording, the $60,000. So another reason, actually we have two reasons here. Another reason to be capitalized is the present value is greater than 90%, right? Oh, actually it's not equal, but it's greater than. Okay, then capital lease obligation and capital lease asset at inception. Yeah, we can use just any of these two. The present value, because present value of MLP is equal to the fair value of the asset at the inception. Discount rate, we use the lower one. And then lease term is 3 years. Because the lease term is the same as the estimated economic useful life. So now we've done the intermediate data input section, and then let's create this the journal entry together. Now first, what do you have to do? Right, the capital lease asset, and at the inception capital lease obligation. How much is that? Right, we got the 60, the same value, $60,000. But we paid, as a lessee, we paid the cash. We paid the cash right away. How much? How much is that? You have to remember, it's not $21,933, the full amount including tax. So $23,933.54. That is the cash out, actual cash out, but that includes property tax expense. Property tax expense. How much was that? 20,000. Oh, sorry, 2,000. Then, how much do we have to get rid of, remove the capital lease obligation? Again, it is inception. When the inception, as soon as we recognize this capital lease obligation, we pay $23,934. That includes the $2,000 property tax and actual principal of, right, just the difference between two, which is the same as this annual lease payment, $21,933. Okay. There's no interest at inception because this capital lease obligation haven't used it yet. So at inception, there's no interest expense recognition. But when close the book, at the end of the first year, the interest expense and depreciation should be recognized. First, interest expense. It's very important to recognize the interest, the expense, and the depreciation because that affects the net income, the actual performance of the company every year. Ultimate goal of a company is to increase the net income every year. So, how much we recognize interest expense that affects the net income is really, really critical. So, interest expense, how do you calculate it? When you calculate interest expense, we always should calculate the principal amount, actual amount we are borrowing. At the moment, we calculate interest expense. How much is the actual amount of the borrowing? 60,000, right? 60,000 minus 21,000. That is the principal amount. Principal amount and 10%. So we need to recognize this interest expense for the first year borrowing, from the first year borrowing. Okay, and then as you can see that this interest expense recognition is incurring when we use others' money, but we don't pay anything at the end of the year. When we close the book, there's no cash payment until the payment very next day, we use interest payable, right? The interest payable, which is the same amount of this. And then we'll remove this interest payable when we pay. So we recognize interest expense and then depreciation. We need to recognize depreciation expense for this capital lease asset. Capital lease asset, $60,000 divided by how long years? How long years the lease term? Right, the 3 years. So 20,000 and accumulated depreciation. We are going to recognize the same amount so that we can reduce the capital lease asset. Okay. That is the first year transaction. Now, once we recognize interest expense, interest payable at the end of the year, now we need to pay a second the payment with interest, including the interest. So the cash amount the company should pay is now the same as 23,934. That is including now the interest amount, which is interest paid. We already recognize interest expense. You don't recognize interest expense once again at the beginning. And then this amount should be removed. So 23,934 is including this interest. And then what else? Right, the property tax expense. Property tax expense, every the payment is including these property tax expenses. Then next, let's just plug in. What is the principal amount of a capital lease obligation that should be reduced from this total amount to $60,000? Right, we can just plug in cash, interest, and property tax expense. So 18,127 is going to be reduced from the capital lease, 60,000, right? So let's move to the end of the year 3, the second payment of the year. The same procedure. We use interest expense and interest payable. Why? We don't pay at the end of the year. We'll pay the beginning year until the payment will recognize the interest payable. So how do you calculate interest expense? Again, we started from the borrowing 60,000. We need to get the principal amount. That is the base of the interest, right? So 60,000 is reduced by 21,000 at the first payment of the principal, and then second payment. So that is the base to calculate interest. So 1,994 is the interest expense that should be paid next day, but we need to close the book until the payment. We need to recognize as a liability, interest payable. Then we need to also calculate depreciation expense because we use this capital lease asset. Capital lease asset, we reduce this capital lease asset by the cost allocation, exactly the same amount, and then accumulate depreciation the same way. Okay, and then finally third payment with interest. Now the same way we pay cash amount, exactly same, recurring the amount 23,934 is including interest payable. We need to remove this interest payable because we paid this cash that includes this interest expense, but we already the recognized interest expense to, yesterday. This interest payable, and then this 23,934 is including property tax. How much? Right, 2,000. And then capital lease obligation. The principal amount is actually reduced by 19,940. As you can see that it has been increased because we paid the capital lease obligation. Capital lease obligation means that the principal of this $60,000 at inception has been the dwindling. So the capital lease obligation definitely is greater than before, and the interest amount is now reduced than before. Okay, now finally, we do not recognize interest expense. Why? Why we do not recognize expense? We'll see the why. Because I can mention at this moment, but we'll clearly understand when we create this balance sheet. But when we pay this capital lease obligation at the third payment, and then this capital lease obligation balance at the beginning of year 4 is going to be 0. So we don't have any borrowing. That's why we don't have to recognize any interest expense. Instead, we just needed to recognize the cost allocation of this depreciation expense in the same amount. So let's pass to this journal entry into the balance sheet and the income statement so that we can see how this balance is going to be changing. Okay, let's start. So the company has the cash and the common stock and the balanced out with the $200,000. Then let's put the first year. The capital lease asset 60,000, and then capital lease obligation 60,000. Okay, so balanced out, and then we receive we pay the cash out 23,934. That includes the property tax expense 2,000, and capital lease obligation now should be reduced by this first payment. Okay, so we balanced out for the first year at inception, and then let's close the book for the first year. Interest expense, how much interest expense? Okay, interest expense is 3,807, and then interest payable until the payment of the next year. Next year the same amount, and then depreciation expense 200,000, and then accumulate depreciation is going to be recognized. So the CLA, the capital lease asset value, the cost is now, the book value is going to be $40,000. And then we have the net income, total net income reduced by 25,807. Again, this depreciation or interest expense recognition is really important because that affects the net income or loss of that year. Now this retained earning should include this net income. So we balanced out first year. And then second year, when we create the second year, it is automatically created. Okay. The second year, we need to transfer all this the information. Why? Because the ending balance of the balance sheet is the same as the beginning balance of the next year. We need to accumulate all this information on the balance sheet, but the income statement is different. Income statement is made for the year ended, so only 1 year transaction. But that income statement account will be retained into the retained earning account in total. Okay, so I'm gonna take all this ending balance to start. Okay, let's start. Interest payable 3,807. Interest payable should be reduced because the company received send the cash, so they don't have any the interest payable the liability, and the cash amount is reduced by the second payment. Property tax expenses, same amount, and the capital lease obligation is reduced by the second payment. So the remaining 19,940. And then at the year end, interest expense is 1,994, and the interest payable now should be recorded until the payment of the very next day. And then depreciation expense, the same amount, and then accumulate depreciation $20,000. So the remaining value of capital lease asset at the second year end is $20,000. Then this is the net loss of the second year should be retained into the retained earning so that we balanced out. Okay. Do you remember why do we not recognize here in the interest expense? Okay, we'll see why. Okay, before that, I'm going to start from the last, the balance, interest payable, and capital lease obligation, and retained earning. Okay, then let's start. The interest payable is now removed because the company paid the cash. The last payment. Then property tax also should be recorded, and then capital lease obligation. Now to see capital lease obligation removed by the amount. Yeah, because we already calculated this capital lease obligation considering the discount rate 10%. Then we already calculated this 21,900 is based on the present value concept. So at the end of the payment, the capital lease obligation must be zero. Okay. So where we are, we've posted the capital lease obligation. Good. And then depreciation last year should be also accumulate depreciation. So we don't have any capital lease asset value. Book value is zero. And then depreciation expense is 20,000. So we don't have interest expense recognition again because the capital lease obligation at the beginning of the year is zero. That doesn't produce any interest expense. So we just put this retained earning including this 22,000 the last year, the net income, net loss. So we balanced out. That's how we record the capital lease for lessee. Okay, see you in the next video clip. Bye bye.